Good morning, ladies and gentlemen. This is Clueless 8. This is the pre-market AM report after monumental ECB rate decision day on Wednesday. Today is Thursday, March 11th, 2016. Every single forecast, every single prediction, and detailed tactical trading analysis that have been presented to Clueless 8 members, Clueless 8 trading members, and free trial subscribers have pretty much come to fruition. Couple of important things that I'm going to kick off with on this video cast. Number one, the behavioral dynamics of investing and trading. As I keep on repeating, majority of investors, traders, hedge fund managers, pension fund managers remain in defense mode and in the bearish camp. Regardless of the rising market, regardless of the humongous double bottom dragon bullish formation presented to us on January 19th and again on February 16th, a majority of market participants have not benefited from this reflex retracement rally that was presented as one of the scenarios weeks ago. In order to succeed in this business, and I am a walking testament to that, one must learn to embrace failure, learn from the mistakes, and I don't think there's any particular mistake per se, but learn from the failures and rejoice in your successes. Confidence is an extremely powerful ingredient, intangible ingredient, both in life and in trading, that cannot be quantified in simple numbers. There's an old saying, confidence is contagious. And the bottom line is, that is exactly what happens in what we do. Saying all that, on a technical basis, this market has more room to go higher. I have studied weekly charts, and as far as I can see, it shows that there are still a few more weeks, possibly till mid-April or so, that I've projected that we are going to basically rise. That could possibly take us back towards the highs of 2100 plus on the markets. It is a possibility. As I always do, I present the bullish scenario within, and I present a bearish scenario within the context of a rising market. There are many things that I can show that I do in my line of work and in my interpretation of things, but obviously there's not that much time to do that in this particular video cast. From a behavioral standpoint, just to wrap it up, we are all playing defense. Some of us are playing defense less and offense more, but we're not in any way or form in animal spirits. When you look at the rise of the market, thousands of points from the bottom, okay? In the case of the Dow Jones Industrial Average, let me see if I can get this up here. 1 second. In the case of the Dow Jones Industrial Average, we rose from about 15,400 to 16,995 and higher yesterday at the top, 17,000 and change. We're talking about a 2,000 point rise. I'll be the first one to say that I didn't take full advantage of what I preach. I have staggered profits all the way up, and I intend to continue to do that. However, my biggest misgiving, and I'm sure many of you can attest to that on your own side, is that we don't stick to technical projections the way we should. And the reason we don't do that are twofold. One is our mental weakness as we play defense, as the scars of the big moves down and all that stuff come into play. We stop ourselves from maximizing what we should do. The second is volatility. Every single one of these red candles cause anxiety and foolish, in many cases, stupid actions on the part of investors and traders. Every single morning, every single day, I try to learn something new. I try to change some of my bad habits and develop powerful good ones. It's not an easy task. A significant amount of traders and investors give up because they do not have the mental fortitude, in my opinion, to do the hard work, the grunt work, the boot camp style behavioral changes that's necessary to take advantage of markets, both on the long and the short side, but specifically on the long side. Every single time the market goes up 100 points, all you hear in the media, in our chat rooms also, is what the downside is. Why doesn't somebody step up? And I'm not talking about myself. I've shown both the upside and the downside, but primarily I've shown some significant upsides that no one talks about. Therein lies the thesis. And that's also shown very clearly in the amount of cash levels, trillions of dollars that are sitting in money market accounts, the lowest number of investor bullish sentiment out there in the case of retail investors, pension funds who are underinvested and significantly lower than average exposure to equities, all boil down to one thing. No one's playing offense. At the time that comes, and maybe it's going to be in a few months, maybe it's going to be a year, I don't know, that offensive investing, which is basically putting in a larger sum than usual into the markets, believing in the markets, the US financial markets I'm talking about, at that point you have a topping pattern. We're not there yet. Now that's a long-term macro picture. The last time we saw this type of investor euphoria, believe it or not, was back in the 2000 tech bubble. And since then, it has not been there. People say that euphoria caused the crash in 2000. I mean, in 2007, 2008. No, it didn't. What caused that was a credit blowout by overzealous, euphoric retail investors, believe it or not, propagated by some large Wall Street investment banks packaging mortgages. More people were excited flipping houses and condos than they were in buying stocks. Believe me when I tell you. So the fact is that nothing really changed when it comes to investor psychology. Everyone is still scared. Enough of that. So let's go back and look at a couple of charts here and put things in perspective. I have said this was a consolidation channel. I showed that last night, and which reminds me, I do have to be forceful on this. Traders and free trial subscribers and investors in the Clueless Day Trading Group who are not spending a decent amount of time understanding my charts, looking at the patterns, understanding the message that's being put through, and I try to keep the charts as simple as possible because believe me, I can make this a heck of a lot more complicated than what they look here. But members who are not spending the time to understand it by sitting in the coaching sessions, by enrolling in them, are doing themselves a massive disfavor. And it doesn't matter how many times I do this video cast. I can assure you, you're not going to be successful in this business. Okay? And a lot has to do with you because the more you understand the charts, more you understand the background of these upwardly thrusting markets or downwardly crashing markets and all these different patterns and such, you will never be comfortable in any trade that you take. You'll always leave early. You'll come in late. You'll always have like, oh my God, what's going on type of exclamation marks. But there's always a reason behind what goes on. Look at yesterday. Look at yesterday. Let's take a look at the SPYs. Let's take a look at the 5-minute. Okay? Look what happened. Mario Draghi before the market. Keep in mind, my videocast said we could go negative. I said, as Mario Draghi's conference call goes on, do not be surprised if the markets go negative. The market went hugely negative. Now, there's a reason behind it. I showed the chart too. You have to scroll back and do your work because I'm not going to show it today, which was the euro-dollar short squeeze, which caught a significant amount of hedge funds and institutional managers who expected Draghi's dovish comments and liquidity pump through QE, through the rates, through his talk, to push the euro lower. Instead, it turned around and went berserk higher. So what do you think that happens? That is an ambush. That is an institutional margin call which had to be met right away on the currency side. That's what caused this drop. You think the smart money, I mean, there is smart money out there, okay? We're the smart money, to be honest with you. Except we don't have those amounts. So, didn't know that what he was trying to do was going to be beneficial to the markets? Of course they knew. Look at the reaction of the markets today. The algos, the HFTs will always manipulate and make sure you are not in the game when it takes off. That's exactly what happened last night. If you didn't have any moderate positions, long positions in the market today, you're back to chasing or sitting around saying, oh, God, I missed it again. How many times are you going to tell your brain that? Because at one point, your brain is fried. You can't do this. Always have to have some position based on the background that I'm showing on and the charts that, you know, after all, the ultimate decision lies with you as to what you need to do. You need to have that. If you look at my trade alerts at the end of the day, you'll see that reasonable multiple long position trade alerts were put in place. Okay, let's take a look at this. This is the hourly chart I'm focusing on. So you have a rising wedge. You can see here, we're not even back in the wedge. This consolidation channel most probably will at least get to, you know, the 209 level here in the S&P 500, 210. And let's not get too nitty-picky about every single point. Oh, it goes to 209.77, we're going to have a crash. That type of stuff is garbage. Right now, the market is on a thrust up. Yes, corrections. Yes, quick consolidative corrections. But not these type of corrections down here. Anything can happen, like I say, full disclosure, but this is not what I'm looking for yet. Bottom line is, at this point, let me get the drawing tool. We are basically, here's the consolidation channel. We're going to break out. We're going to hit resistance here at yesterday's highs. We're going to probably zigzag pull back a little bit here. And then it's going to try to thrust up again. I believe that the 2024 level or so, which was the last supply point of large selling right there, is going to act as a major resistance. Once we clear that, and we could be trading in a band between 2024 and 1990. So you're looking at a 50-point band or roughly a 200-point or so. I'm sorry, a 250 to 300-point volatility band within the Dow. As we get into, very importantly, the middle of the month. We have a Fed meeting on the 15th, which is going to be one of the most important Fed meetings in recent memory because we're going to find out whether or not the Fed is going to raise rates the second time round. Given the preponderance of economic stats that are coming out, releases that are coming out, the U.S. economy seems to be in pretty strong footing. So what we do need to see between now and the Fed meeting is somewhat slightly softer numbers, believe it or not, because that takes away the pressure of the Fed from raising rates right away in March. Whatever the case, there's going to be volatility. Therein, that's where the 2020 and the 1990 S&P play comes into. Basically, that trading band comes into play. So expect volatility next week, give or take a few days around the 15th. We know that, right? We've seen that hundreds of times before. Multiple times before. So once we clear this, which I believe we will, possibly by the end of March, we get towards the 24, up towards the upper end of the rising wedge. At that point, either we bust loose or we have a nice sizable correction. In my opinion, if you look at this pattern here, up from the 2050 level or so. So if we fall from 2050 down to, let's say here, which is this pattern, right? That's going to feel like a real big move down, and I'm going to be ready for it. Remember, tactical trading, not emotional BS. Let me just tell you one thing here. Yesterday was a fantastic day. But was it easy? Absolutely not. I was wiped out by the end of the day. And then I had to do a couple of things with my family. Because we're working people, right? We are. We are capitalists. We work. We don't sit there and things should be handed out to us. Bottom line is, the last trade, which worked out fantastically well, which was the S&P calls, and I showed every single tactical move on the thing, and that's hard work, believe me. In the middle of my own day, trying to manage my own trades and putting out all these fantastic real-time charts on the Algo HFT, for example, to help people. But that trade took guts, took tactical quantitative analysis on my part. Always an element of luck, there's no question about it, but I knew the fundamental reason what was going on. And that was that the euro dollar situation was going to ease. Walk people through it. But that was a tough trade because we went down, kept on buying the lows, and then the thing just took off like a rocket. And that was just one trade. So what I'm getting at is that this business is a fantastic business. But in order to be successful in this business, you really have to put in some grunt work. Now, saying all that, I'm trying to get this. Looks like it won't let me in. That's great. All right. So let me just move on to. So let me just show you on this chart. Let's leave it at that. So bottom line is that we have a downside here on the lower Bollinger in the 60s. Could happen. We have an upper Bollinger here. I'm sorry, acceleration band here in that 2010 mark. We have 2000 as the Bollinger, and then we have 1976. So 2000 and 1976 is the Bollinger trading band. The acceleration trading band is basically the highs 2010 and 1960, and that's a wide one. So what I'm getting at is that we still, I believe that when you have a gap open of 18 points higher or so, you got to take your profits. That's it. Gap opens, you take your profit. If you're short, you gap down, take your profits. You can leave some runners out there, but remember one thing, don't get complacent. You get complacent in this market, then you are going to, then it's going to hurt you. Oh, here we are. I think I'll be able to show this. All right, so this is where we are with the futures right now. You can see on the 1 hour chart, this is a 1 hour chart, okay? We are overbought. And looking at the daily, and I've shown this pattern symmetry a zillion times. Glad that I got this up. I got 2 minutes here left on this. You can clearly see, if you just, just your naked eye, just look at this thing here, that this move here up to this move here completes the pattern. In my opinion, that pattern does get completed by the end of March. Could be wrong, but who cares? Because the bottom line is I'm putting my credibility out there, which I've been doing for years, and successfully so, in predicting and forecasting markets at a level that very few people have. And for that, I'll take certain credit. I will take full credit for. Now, regarding trade management, how you do it, it's your mental part. Find your amygdala. Don't know what that means, look it up. Okay? Amygdala, AMYGDALA. All right? Look it up, seriously. Find it, work with it, and be successful. Because all these brilliant charts that are put out there, tactical trade alerts that are put out there, is this a spectator sport? Ask yourself how many times you've taken advantage of it. I ask myself that every day. And believe me, I'm not happy with the answer. So if I'm not happy with the answer, a lot of you must be miserable. And I mean it in a nice way. So saying all that, I'm going to wrap this up. Sign up for the weekend coaching sessions. I'm definitively doing a terrific advanced coaching sessions this weekend. I'll try to, it's like I said, around Sunday evening. I'm open to doing individual coaching sessions probably early Saturday or early Sunday. Those are good because in between, I got stuff to do with the family. God bless you all and have a terrific day. Trying to keep this as simple as possible. There's your pattern symmetry that even the gurus on Wall Street completely missed. Thank you for listening. Clueless A Trading.